Friday morning, January 30th, 2026. You opened your trading account expecting to see your silver position sitting comfortably at a profit. Instead, you saw a single word that changed everything. Liquidated. Your broker didn't call you. They didn't ask permission. They didn't give you a chance to add margin. They simply sold your entire position at $78 per ounce. 6 hours earlier, silver was trading at $120. You went to sleep thinking you were winning. You woke up to discover the game was already over. This wasn't bad luck, this wasn't a mistake, this was the system working exactly as designed. And if you don't understand how it happened, you're going to watch it happen again. Welcome to the flow of money. The mechanics of what occurred on Friday are not complicated, but they are brutal. When a trader uses leverage to buy silver futures or contracts for difference, they are not buying the metal itself. They are buying exposure to price movements using borrowed money. The broker provides this borrowed money, but they require collateral. That collateral is called margin. In a normal market, margin requirements for silver might be 10%. This means a trader can control $100,000 worth of silver with only $10,000 of their own money. The leverage amplifies gains. A 5% rise in silver prices generates a 50% return on the trader's capital. But leverage is a two-sided blade. That same 5% decline wipes out 50% of the account. And when the account value drops below the maintenance margin requirement, the broker issues a margin call. A margin call is not a request. It is a demand. The trader has a limited window, sometimes only hours, to deposit additional funds. If the trader cannot or does not meet the margin call, the broker has the legal right to liquidate the position. They sell the trader's holdings at whatever price the market offers at that moment. No negotiation, no appeal, no second chance. This is not cruelty. This is risk management. The broker is protecting themselves from the trader's losses exceeding the account balance. Because if the trader's account goes negative, the broker absorbs that loss. They will not allow that to happen, so they sell first and explain later. On Thursday, January 29th, silver touched $120.64 per ounce. This was a record high. Traders who had been holding silver for weeks or months were sitting on enormous paper profits. Those who entered with leverage were seeing triple-digit percentage returns. The euphoria was overwhelming. Social media filled with screenshots of gains. Online forums celebrated the squeeze. Retail traders believed they had finally beaten the system. Then the Warsh announcement came. President Trump nominated Kevin Warsh as the next Federal Reserve Chair. Warsh is known for his hawkish stance on inflation and monetary discipline. The market immediately recalculated its expectations for interest rate policy. The assumption of aggressive rate cuts evaporated. Bond yields rose, the dollar strengthened, and precious metals, which do not generate yield and become less attractive when interest rates rise, began to fall. The decline started slowly. Silver dipped to $115. Some traders saw this as a buying opportunity. They added to their positions using more leverage. Then the selling accelerated. $110, $105, $100. As the price broke through the psychologically important $100 level, something changed. The selling became self-reinforcing. Traders who had bought silver at $110 with leverage suddenly found themselves underwater. Their account equity was shrinking. Margin calls began arriving. Those who could not or would not deposit additional funds were liquidated. And when their positions were closed, the brokers sold their silver into the market, pushing the price lower, which triggered more margin calls for other traders. This is the cascade effect. At approximately 2:30 in the afternoon Eastern Standard Time, the cascade reached critical mass. Silver dropped from $95 to $85 in less than 15 minutes. Stop-loss orders, which traders had placed as a safety mechanism, were triggered automatically. These orders added to the selling pressure. Algorithmic trading systems, which are programmed to follow momentum, detected the downward acceleration and began shorting silver, further amplifying the move. The liquidity that had been abundant during the rally disappeared. There were no buyers. Market makers, the firms that are supposed to provide liquidity by quoting both buy and sell prices, widened their spreads dramatically. Some stopped quoting prices altogether. They were unwilling to catch a falling knife. Without liquidity, the price had nowhere to go but down. By the time silver bottomed at $78.53, the intraday decline was 31.4%. This was the worst single-day drop for silver since March 1980. For traders using leverage, the losses were catastrophic. A trader who had controlled $100,000 of silver with $10,000 of margin saw their entire account wiped out. Not just their profits, their entire capital, gone. And for those who had added margin during the decline, thinking they were buying the dip, the losses extended beyond their initial investment. Some accounts went negative. The broker liquidated the position, but the sale price was so low that it did not cover the borrowed amount. These traders now owed money to their brokers. The psychological impact of forced liquidation is severe. A trader who chooses to sell even at a loss retains a sense of control. They made a decision. They accepted the outcome. But a trader who is liquidated has that control taken away. The broker made the decision. The broker chose the timing. The broker selected the price. and in a cascading market, that price is always the worst possible price, because brokers liquidate during panic, when liquidity is lowest and bid-ask spreads are widest. The trader is left not only with financial loss, but with the bitter knowledge that they were forced out at the bottom moments before the market stabilized. Silver recovered somewhat after the initial plunge. By the end of Friday's trading session, it had climbed back to around $95. This recovery provided no comfort to those who had been liquidated. They were no longer in the market. They could not participate in the rebound. Their positions had been closed at $78. The recovery happened without them. This is the cruelty of leverage. It allows traders to participate in the upside with amplified returns, but it guarantees they will be removed from the market at precisely the moment when staying in would have been most profitable. The institutions understood this dynamic. Large hedge funds and proprietary trading firms watched the retail traders pile into leveraged silver positions throughout January. They saw the open interest in silver futures climb to record levels. They knew that much of this open interest was held by undercapitalized retail accounts using maximum leverage, and they knew that a sudden price decline would trigger a cascade of forced liquidations. So when the Warsh announcement provided a catalyst, the institutions sold, not because they believed silver's long-term fundamentals had changed, but because they understood the short-term mechanics of a leveraged unwind. They sold into the rally, took profits, and then watched as the cascade did exactly what they expected. This is not conspiracy, this is market structure. Retail traders operating with limited capital and high leverage are structurally disadvantaged. They cannot absorb volatility. A 10% drawdown liquidates them. Institutions operating with deep capital reserves and lower leverage can absorb the same drawdown and wait for the recovery. The system is designed this way. Margin requirements exist to protect brokers, not traders. Forced liquidation exists to transfer risk from the broker to the trader, and in a cascading market, that risk crystallizes as realized loss at the worst possible moment. The question retail traders should have been asking before Friday was not whether silver would continue rising. The question was whether their account could survive a sudden correction. Most could not. Industry data suggests that retail trading accounts using leverage have a failure rate exceeding 90% over a 12-month period. This is not because retail traders are unintelligent. It is because the structure of leverage trading is adversarial. The broker profits from volume and spreads. The market maker profits from volatility and bid-ask spreads. The institution profits from information and capital advantages. The retail trader using borrowed money and facing margin calls is the counterparty absorbing the losses. Gold experienced a similar but less extreme version of the same dynamic on Friday. It fell as much as 12% intraday, dropping below $5,000 per ounce before recovering slightly. Gold futures traders, many of whom were also using leverage, faced margin calls and forced liquidations. But because gold's price movements are generally less volatile than silver, fewer traders were completely wiped out. Still, the losses were substantial. A trader holding 100 ounces of gold futures with 10% margin saw their position lose value from $560,000 to $440,000 at the lows. That is a $120,000 decline in nominal exposure. For a trader with $56,000 in margin, this meant their account was reduced to negative $14,000 before the broker could liquidate. That trader now owes the broker $14,000, in addition to having lost their original capital. The recovery in both metals after the initial plunge created a secondary psychological trap. Traders who had been liquidated watched the prices climb back toward $100 for silver and $5,000 for gold. They faced a decision: re-enter the market, hoping the recovery would continue, or stay out, accepting the loss. Many chose to re-enter. They borrowed more money, opened new accounts, and bought back in. This is called revenge trading, and it is almost always destructive, because the trader is no longer operating from a position of calm analysis. They are operating from emotion. They want to recover their losses quickly. They use even more leverage than before. And when the next decline comes, as it inevitably does in a volatile market, they are liquidated again. This cycle can repeat multiple times, each iteration destroying more capital until the trader has nothing left. Friday's massacre was not an isolated event. It was the predictable outcome of a market structure that concentrates risk on the least capable participants. The retail traders who bought silver at $110 with 10-to-1 leverage were not making an investment, they were making a bet. And the house, in this case the brokers and institutions, has a structural edge. The house does not need to predict the direction of the market. The house simply needs to wait for volatility, because volatility triggers margin calls. Margin calls trigger liquidations, and liquidations transfer wealth from leveraged retail accounts to unleveraged institutional accounts. The data supports this analysis. On Friday, trading volume in silver futures spiked to levels not seen since the initial rally began. But this volume was not driven by new buyers entering the market. It was driven by forced sellers exiting the market. The open interest, which measures the total number of outstanding contracts, declined sharply. This indicates that positions were being closed, not opened, And when positions are closed during a price collapse, it means traders are being liquidated. The institutions who had sold earlier in the week were the buyers at the lows. They bought back silver at $78 that they had sold at $115. They captured the spread. The retail traders who were liquidated at $78 provided the liquidity for those institutional buy orders. There is a fundamental lesson embedded in Friday's events. Leverage is not a tool for wealth creation, it is a tool for wealth transfer. In a rising market, leverage allows traders to amplify gains, and this creates the illusion of free money. But markets do not rise indefinitely, they correct, and when they correct, leverage amplifies losses. The trader who made 50% on the way up loses 100% on the way down. The mathematics are unforgiving. A 50% gain requires a 33% decline to erase, but a trader using 2-to-1 leverage is wiped out by a 16% decline. At 10-to-1 leverage, a 5% decline is fatal. This is why leverage trading accounts fail. Not because the traders are wrong about direction, but because they cannot survive normal volatility. The institutions know this. They design their trading strategies around it. They do not use maximum leverage. They do not chase momentum. They do not enter positions that require the market to move in their favor immediately. They structure trades with enough capital buffer to absorb volatility. They place stop losses at levels that reflect actual risk tolerance, not arbitrary technical levels. And most importantly, they do not trade with money they cannot afford to lose. Retail traders, by contrast, often violate all of these principles. They use maximum leverage to maximize potential returns. They chase price momentum, entering at tops. They place tight stop losses that are easily triggered by normal volatility. And they trade with money that represents a significant portion of their net worth. This is why they lose. Friday also revealed something about market liquidity that many traders do not understand. Liquidity is not constant. It is abundant when markets are calm and prices are rising, but it disappears precisely when it is needed most, during sharp declines. Market makers, the firms that provide buy and sell quotes, are not obligated to maintain tight spreads during extreme volatility. They widen their spreads to reflect increased risk. A market maker who quotes a 1-cent spread during normal conditions might widen that spread to $5 during a cascade. This means a trader trying to sell silver at $90 might receive a bid of $85. The $5 difference is the market maker's compensation for taking the risk of holding a falling asset. For a leveraged trader facing a margin call, this spread is devastating. They must sell at the bid price, which is far below the last traded price, crystallizing a larger loss than they expected. The lack of liquidity on Friday was exacerbated by another factor. Many market makers are also broker-dealers. They facilitate trades for clients while also trading for their own accounts. When the cascade began, these firms faced a conflict. Continue providing liquidity to clients, absorbing losses on their proprietary book, or stop quoting prices and protect their own capital. Most chose the latter. They stopped quoting. This is rational from their perspective. They are not charities. They are businesses with risk limits. But for traders who needed to sell, the absence of market maker quotes meant there was no floor. The price could and did fall to whatever level generated a buyer. On Friday, that level was $78. Not because $78 reflected fair value, but because $78 was the price at which someone was finally willing to step in. The COMEX, the exchange where silver futures trade, has mechanisms designed to prevent crashes. Circuit breakers are supposed to halt trading when prices move too quickly, but these mechanisms have limits. They can pause trading for 5 or 10 minutes, but they cannot prevent a determined cascade. When trading resumes after a halt, if the selling pressure remains, the decline continues. And on Friday, the selling pressure was relentless. Each circuit breaker pause provided a brief respite, but when trading resumed, the cascade continued. This revealed the limitation of circuit breakers. They slow the crash. They do not stop it. There is also the issue of margin requirements themselves. These requirements are set by the exchange and the broker. During calm markets, they are relatively low, encouraging trading volume. But during volatile markets, brokers often raise margin requirements. This means traders who were adequately margined on Thursday might find themselves under-margined on Friday, even if they did not lose money. The broker simply changed the rules. This happened to some traders on Friday. Their positions had not declined enough to trigger a standard margin call, but the broker raised the margin requirement and suddenly they were in violation. They were liquidated despite believing they had sufficient buffer. This is legal. The broker's terms of service grant them the right to change margin requirements at any time. But for traders who were not aware of this clause, it was a shock. Another dimension of Friday's massacre involves options. Many traders were not holding futures directly. They were holding call options on silver, betting that prices would rise. These options have leverage embedded in their structure. A call option with a strike price of $100 becomes worthless if silver falls below 100. On Thursday, with silver at 120, those options had significant value. On Friday, with silver at 78, those options expired worthless. The traders who held them lost 100% of their investment. But unlike futures traders who were liquidated and might have salvaged some capital, options traders lost everything. The option went to zero. There was nothing to liquidate. The premium paid for the option was simply gone. The volatility on Friday also affected exchange-traded funds. The SLV, which is the largest silver ETF, saw a massive trading volume. Investors who held shares of SLV watched the fund's net asset value plunge by 31% intraday. But unlike futures traders, ETF holders were not liquidated. They could hold through the decline and participate in the recovery. This is a critical difference. ETFs do not use leverage. There are no margin calls. An investor who owns 100 shares of SLV owns 100 shares regardless of price. The value fluctuates, but the shares remain. This structural advantage allowed ETF holders to survive Friday's massacre. Many did not sell at the lows. They held, and by Monday their positions had recovered somewhat. This is not to say ETFs are without risk, but they do not carry the forced liquidation risk that leverage creates. The broader question is what Friday's events reveal about the silver market itself. For months, bulls had argued that silver was in a structural supply deficit, that industrial demand from solar panels and electric vehicles was outstripping mine production, that central banks were buying silver along with gold as a hedge against currency debasement. These arguments were and remain factually accurate. Silver does face a supply deficit. Industrial demand is strong, but Friday demonstrated that fundamentals matter less than financing during a liquidity crisis. When leverage positions unwind, price discovery becomes disconnected from supply and demand. The price is not reflecting the value of the metal. It is reflecting the desperation of forced sellers and the absence of willing buyers. This disconnect can last for hours or days or weeks. Eventually, fundamentals reassert themselves, but eventually is too late for traders who were liquidated in the meantime. Institutions that shorted silver during the rally are now sitting on substantial profits. A hedge fund that shorted silver at $110 and covered at $80 captured a $30 spread on every ounce. For a position of 1 million ounces, that is a $30 million profit realized in a matter of hours. These institutions did not have better information about Warsh or Fed policy. They simply recognized that a market driven by leveraged retail speculation is vulnerable to a cascade. They positioned accordingly. This is not manipulation. This is recognizing market structure and trading around it. For retail traders who survived Friday, the question now is whether to re-enter or stay away. The technical analysis offers little clarity. Silver is oversold on shorter time frames, which suggests a bounce is possible, but it is also broken on longer time frames, which suggests further downside is equally possible. The fundamentals remain supportive, but fundamentals did not prevent Friday's massacre. They will not prevent the next one either. The decision to re-enter must be based not on optimism or fear, but on risk management. A trader must ask whether they can structure a position that survives another 30% decline. If the answer is no, they should not trade. If the answer is yes, they must define exactly how that survival occurs. How much capital? How much leverage, if any? What is the maximum tolerable loss? At what point does the position get closed, and who makes that decision, the trader or the broker? The safest structure is to own physical silver with no leverage. Physical silver cannot be margin called. It cannot be liquidated by a broker. It simply sits in a vault or a safe, holding value. If the price falls, the owner still possesses the metal. If the price rises, the owner participates in the gain. This structure eliminates the risks that destroyed traders on Friday, but it also eliminates the leverage that amplifies returns. A trader with $10,000 can control $100,000 of silver futures, or they can own approximately 105 ounces of physical silver. The futures position offers 10 times the exposure, but the physical position offers something futures cannot provide: permanence. It cannot be taken away. The institutions that control large flows of money understand this distinction. They do not use maximum leverage. They do not chase momentum. They allocate capital across structures with different risk profiles. Some capital in physical metal for long-term wealth preservation. Some capital in futures for tactical trading with defined risk. Some capital in options for asymmetric payoff structures. And always, they maintain enough liquidity to avoid forced liquidation. This is not because they are smarter than retail traders. It is because they are better capitalized and they respect the mathematics of leverage. Friday's margin call massacre was a lesson delivered with brutal efficiency. The market does not care about your thesis. It does not care whether silver is fundamentally undervalued. It does not care whether you are right about the long-term trend. It only cares whether you can meet the margin call when it arrives. And if you cannot, it removes you from the game. This is the flow of money, from the leveraged to the unleveraged, from the speculator to the institution, from the trader who hoped to the trader who prepared. The system is not designed to help retail traders win. It is designed to extract their capital during moments of maximum stress. Friday was one of those moments. There will be others. The question is whether you will be liquidated during the next one, or whether you will be the one buying at the lows when everyone else is forced to sell. That choice is not made during the crisis. It is made now, in the structure of your positions, in the amount of leverage you use, and in the capital you reserve for the moment when everything breaks, because it will break again, and when it does, only those who prepared will survive. The margin call massacre of January 30th, 2026 was not about silver. It was not about Kevin Warsh or Federal Reserve policy or technical chart patterns. It was about a simple truth that the financial system does not advertise. Leverage is not designed to help you win. It is designed to ensure you lose at the exact moment when holding would have saved you. The broker who liquidated your position at $78 was not being cruel. They were being rational. They protected their capital by sacrificing yours. The institution that bought at the lows did not have secret information. They simply had enough capital to survive the volatility that destroyed you. The system worked exactly as intended. It transferred wealth from accounts that could not absorb a drawdown to accounts that could. So here is the question that actually matters. When the next cascade comes, and it will come, will you be the one forced to sell, or will you be the one with capital ready to buy? Because that is the only question. Everything else is noise. The thesis does not matter if you cannot survive the drawdown. The fundamentals do not matter if the broker closes your position. The long-term trend does not matter if you are removed from the market during the short-term panic. Friday showed who understands this and who does not. The leveraged retail traders are gone. The institutions remain. This is not luck. This is structure. This is mathematics. This is the flow of money. And the flow only moves in one direction. From those who borrow to those who lend. From those who hope to those who prepare. From those who were liquidated at $78 to those who bought at $78. The system has shown you how it works. The question is whether you were paying attention.